Good morning, everybody. This is Kirk Spano, Investing 2020s, and I am back from Las Vegas after 17 days. And I will tell you, I was very tired at the end. So 17 days of poker mixed in with friends and family is a very tiring experience. I don't recommend it for anybody. If you want to play poker like a pro, then ignore everything and just play poker like a pro. So let me tell you about my poker experience this year, because I think it's relevant to how we think about investing. I've talked to you about poker before and investing, and they are similar in the aspect that risk management, not losing all your chips, not losing all your money, is the very first thing that you have to think about. I do that pretty well. In my first 4 tournaments this year, I got busted all 4 times as a big favorite. I'm going to show you how I lost. This first screen that you're seeing is a pair of aces against a king-queen suited. And in this hand that I busted out of the monster stack, there was a player who had sat down after the dinner break. It was the last chance he had to buy into the tournament. And he just came out firing. Every time he had big suited connectors, he got it all in, trying to win a few hands in a row and see if he could get a big stack of chips. Well, the first 2 times he played, he won, even though he was an underdog. The third time, and I had already decided until he settled down, I'd only play aces against him. Well, I got aces. So here I am with aces, and he raises, I re-raise, and he says, well, let's do this, and he goes all in. I have to go all in with a pair of aces. I'm an 82% favorite. The flop is Jack, 10. I'm still an 81% favorite. The only card he can get to beat me is a 9. The ace would give me a full house. That would beat his straight. Right now, he's king, queen, Jack 10 to a straight. Turn is the 4 diamonds. And the river, of course, is the 9 hearts. He wins. Some other hands I got in. The second run at the monster stack was the first hand back on day 2. So I had made it to day 2 of the monster stack. Millions of dollars of prizes here. First hand, I'm on the button, which is the last to act before the blinds, pre-flop. And I raised. I had 104,000 in chips, and the blinds were 1,500, 3,000. I made it 26,000. Huge raise, 9 times the blind. Normally you bet between 2 and 4 times the blind. And the guy looks at me. He thinks I made a mistake because I only put in 2 chips, a 25,000 chip and a 1,000 chip. He thought I meant to go to 6,000. He was induced to go all in, thinking I made a mistake on putting my chips out. I didn't, but it's still pretty good for me. I'm a 3-1 favorite here. And of course, the flop is queen, queen. I never catch up. I got yelled at by a friend of mine. Well, why didn't you just bet less? I'm like, because I got ace king and I want to get to 200,000 in chips quickly. Interestingly, the big blind hadn't sat down yet. He hadn't showed up at the table firsthand. So there was 6,000 in dead chips in the pot. This guy decides, well, I'm going to jam it all in with king, queen. And he catches fire. Supposed to win that 3 out of 4 times. In the senior event, I got an ace king in against ace queen pretty early in the tournament. He hit a queen, busted out. And then again, ace king diamonds versus another ace queen. And he ended up making the hand. So what you see in all 4 of these circumstances is that I was a 80% to 70% favorite, still lost, even with aces. Why is that important to invest? Because sometimes bad things are going to happen. Usually bad things have to do with management, not executing their business plan, but there's all sorts of other things, accounting problems, sudden competition, sales force that doesn't sell, all sorts of things. And that's why you have to make your bets small. You have to make your bets far apart, scale in slowly, and you really have to manage your risk. Now, in poker, what I will tell you is this. Because the tournaments are super top heavy in payments and in prizes, you do need to build up a lot of chips by the middle of the tournament or you're in big trouble in most cases. Yeah, chip in a chair is a thing. And I've won tournaments being really low. In fact, in one of the tournaments that I ended up playing later, I was down to 3,300 in chips, which was only 6 big blinds at the time. The blinds being about 1,000, I believe they were, or 500, 3 and 5. Yeah, they were 3 and 500. And I was down to 3,300 from a starting stack of 25,000 because I ran into some bad luck. I lost with aces and ace king in that tournament. It happens over and over again. Why? Because so many people gamble that they can defy the odds for a little while. Kind of like short investors who try to short things to zero. Sometimes they need to pick up their chips and leave, but they don't. They don't cover their bet. They just bet and they bet and they bet. And they think they're winning, they think they're winning, they think they're winning until they lose. And then they cry. Oh, I got so unlucky. No, you defied the odds by getting lucky, then the odds caught up with you. So if I can play ace king over and over and over again, and then tap the brakes once I have some chips, it's a good strategy. Why? Because when I bet all in with ace king, most times people will fold, over half. So I win all those pots. Can't really do that in the stock market. But the concept is important when you decide to try to buy something near what you think is a bottom. And the ace king is going to work well against other Broadway cards, ace queen, king queen, 3/4 of the time. And you're actually going to win 48 or 49% of the time against a pair, unless the pair is aces or kings. So ace king is a great hand, but it's not a made hand, but it's a great gambling hand. When you play poker, you do need to gamble a bit. And you generally want to gamble early, or at least towards the middle of the tournament, so you can build up a lot of chips. And then you adjust your strategy, you slow down a bit, pick your spots different. Or maybe you get so many chips that you can bully people around because you're constantly threatening them with busting out. Investing has a few similar situations. One of them is when a small cap stock is being shorted and you know that the stock is worth a lot more than current share price. And we're seeing that with one of our stocks right now. And I suspect we're going to see it with a half a dozen more in the next year. I think the next year is going to be pretty good for us because we've gotten to know a whole bunch of small cap stocks that are under pressure. And some of them have started to go up already. And I think others are going to start to go up as well. So that's the first thought today is investing is like poker and that there is gambling involved, except that the best way to win is to exploit the gamblers. Just try to make really good decisions over and over and over again, and eventually things work out. That's behind the idea from Peter Lynch, who said, look, invest in small cap stocks because some of the big winners, the handful of big winners you have, offsets everything else. It'll make you successful in the long term. The trick to small cap investing is to truly understand businesses that you're invested in, what their total addressable market share is, and what percentage of that you think they're going to get. Warren Buffett talks about knowing your companies inside and out over and over again. He has the punch card idea. If you could only make 20 investments in your life, you'd be really careful about it. I round that up to about 30. I think most people can handle about a 30 stock portfolio, but not anymore, because you truly don't know what you're investing in. And another idea to remember is that about 80% of the stocks in the stock market are not worth investing in individually. And you better have that pounded into your brain, because if you don't, you will never be a good investor. And why do I say that? It's because statistically, we know that about 20% of the stocks account for all the gains above the market average. And in fact, it's a single digit percentage, 5, 6, 7% of the stocks are the ones that really crush the market. So 19 out of 20 stocks don't really do anything special. It's about 1 in 20. And then you'll have 2, 3, and 4 that beat the market. But then everywhere from 15 or 16 up, anything from the 4th and 5th stock, best stock, anything from about the 5th stock on doesn't do that well, about average or way below. And in fact, what we know is that about 2/3 of the stocks never ever beat the average, in fact, trail substantially. So if you make it in your head, if you look at it in your head like it's a bell curve, it's not a perfect bell curve. It's pushed way to the right. And it's not even a bell curve. It's just a parabolic curve, like the prize money in poker tournaments. If you don't finish in the last 4 tables or so of a big tournament, really the last 5%, you don't make any money. So in the rest of those tournaments I played, and I played 10 tournaments, busting out the first 4, down $5,000 after 5 days, 6 days. Then I cashed the senior event on my 3rd try, got $1,000 back net. Still down $4,000 after 5 tournaments. And then I cashed 3 of the next 5, including coming in 14th at the Win, 37th at the Golden Nugget. Paid for the whole trip. I basically got to spend 17 days in Vegas for free, pay off my investors because they gave me about $1,000 to play with on their behalf. I turned every $1 because of the events I played in that they had access to. My investors got $1.72 for every dollar they gave to me. 72% return in 17 days, not bad. And that was with the crummy start. So when you're investing and you're down and you get depressed, think about that. Stock market, just like gambling, is a game of streaks. Sometimes you plod along, you take some small losses, take a couple big losses, then all of a sudden, zoom to the moon. So what I'm going to talk to you about today is Shooter's Primary Waves, which is now getting published at Margin of Safety Investing 2 each week, because these charts that he does will help you visualize roughly where a stock is based on market sentiment, market mood, various technical indicators, so that you can get an idea of where these stocks are and about when you should buy them or trim them. And Elliott Wave is right-ish about 60 to 80% of the time, depending on who you use and a very loose interpretation of what's right. Really what Elliott Wave does is give you a shape that's not terribly precise, but it's accurate. What's the difference between precise and accurate? Accurate is the broad view of things. Precise is really getting trades perfect, and it's just not possible. Nobody has ever become rich as a trader. It's true. There is not a single billionaire who's a trader. Now, you can hit a big trade, make a few $1,000,000, and since you only have to make a lot of money once to have a lot of money, if you're smart, unlike the gambler who just keeps betting inferior hands, you can stop and say, hey, I made a few $1,000,000. Now I need to just not screw it up and give it away back in the market. So for Shooter's Primary Waves, which again, you now get on Margin of Safety, you get a little commentary from him once in a while from Shooter, a user's guide, Elliott Wave Basics. This one's a little bit more complex, but you should look at these. And then he'll give you your charts, and I've asked him just to bullet point a couple thoughts. He tells you it's in a wave 3 of a primary wave 3, intermediate wave of a primary wave. What does that mean? These charts are fractal. What does fractal mean? Pattern within a pattern, a wave within a wave, smaller wave inside of a bigger wave. And if you read the directions in his educational pieces, you'll get the basics, and that's all you really need if you're a position trader. If you're a position trader, meaning long-term, measuring your trades in quarters and years, this will be perfect for you. If you're a day trader or a swing trader, you need a lot more, including a lot more time and a lot more education, which is why I say that 4 out of 5 people should not swing trade, even though I sell a service for swing trading. 4 out of 5 people should be position traders and measure your trades in longer time frames. For the 1 in 5 of you who have the time to trade and learn how to do it, again, the rare membership at Fundamental Trends is probably for you. But if you don't have time to trade and really put in that much education, you can still beat the stock market pretty handily with good longer term trades and going all the way back to the idea that 4 out of 5 stocks are shit because they're just too risky and they generally never outperform the market anyway. And if a stock can't outperform the market, Why wouldn't you just own ETFs in your favorite sectors and very slowly trade those? So let's just take a look at one of his charts. Intel. He had this nailed pretty much all the way down. He had a primary wave setup of 24.59, which is about where it got to. His weekly trigger was 29.46. So this is where he originally thought it would get to, 29.46. Got down to 24.59, kind of a back up the truck moment. Now it's up into the 30s. This chart's a little bit old. Oh, actually, this chart's pretty new. This one's 7.2, so that's the other day. So Intel's into the low 30s, and it looks like it's heading to about 42. Now, he says here that it could actually go up to about 53. So somewhere between 42 and this area up here is what he thinks. See where this turns over? A lot of times that'll be in the zone. So as it gets into the 40s, you'll have to decide, do you want to hold it forever? Because it'll probably come down then and then go back up. Hold it forever until it breaks out above its old highs. Or do you want to trim it and then buy it back? It's up to you, your style. But that next correction could be substantial, back down into the 30s. So if it gets into the 40s, do you want to sell a third of it? It's usually what I do, and then buy it back down here. Because if it keeps running, you still have 2/3. If it does come back, you've shaved off some of your cost basis. Again, up to you whether you do that. Some of the other charts, Shopify, which I talked about, weekly trigger, daily trigger, ultimately got down here. But even if you bought it at 39 and 28, then ultimately put more in at 23, you're way up because now it's into the 60s. Scaling in slow and wide and over several months. Can't be perfect, but you could be excellent. So you would have doubled your money on Shopify had you scaled in. I didn't. I had other things on my plate. Can't get into every good idea. Tesla, way back up here, I told you it was going to probably lose half. It lost more than half. He has a primary wave going all the way up to 339 for a pullback to 274. So the price I wouldn't buy Tesla above is probably 274 in case it gets here and rejects, which could be happening. It's up today. So we'll see if it does head up here or if it ends up reversing sooner than we expected. Again, can't be perfect, but if you understand what all the different levels mean, like these resistance levels, which could reject it, then maybe it comes all the way back down here to the lower 200s. Interesting thing about Tesla, I think, is the deals that they've basically started to standardize the charging networks. Everybody's going to move to Tesla's system, and they're going to get less competition now because Ford and GM and other car dealers are just going to use their existing supercharger network and add on a bit. Travel America, which got bought, is adding chargers. So is Pilot. So all of the truck stop places are adding superchargers. You have them at places like malls and doctors' offices and casinos. So the idea that people have had that there's not going to be enough chargers by 2026 and 2027 when EV sales are really set up to take off is pretty much wrong. So anybody who talks about not having enough chargers out there just really truly doesn't know what they're talking about anymore. You're going to have tons more chargers in the next 3 years. Plus, and I have an electrician coming over to our condo to add charging for our garage because when we sell, it's going to be a selling point. So that little cheap upgrade to our home electrical system is going to allow us to get more money for the house. It's one of the things you will actually get paid for. So if you have a condo, but it's not upgraded to handle charging, you're going to want to pay for that. And it won't cost you much. Probably under $1,000. But then somebody with an EV who's prone to spending money if they've bought an EV already, probably pay you for your house too and say, hey, I'm going to buy this one instead of that one because this guy has it set up for EV charging. In any case, Tesla probably does go back to being $1 trillion company. We've talked about that again and again. So if I can get a correction here down to the low 200s, I'm probably going to buy it. And I think there's a good chance that happens. If it breaks out to 339, then comes back down to 274, I'll probably ignore it and just own it through QQQ. I should have loaded the bus, loaded the truck, and loaded the train down here, and I didn't do it, even though I knew when it was 400, it was coming back to 200. And it went down to, 115 or something it got down to. You live and you learn. You love and you lose. And everything else. Palantir, he had this one nailed. He knew that when it got down to here and started chopping around to buy it, he's projecting it all the way up to 30. Now, at 30, I don't know how much of my Palantir I keep. I probably just take the double or 2.5 timer, and I take all my profits off the table at some point. So as Palantir approaches 30, I'm going to be very likely to take most of my profits, and I'll probably start in the 20s. Probably here and here and here. Scale out slowly and over whatever time frame that would end up being. I'm not going to talk about AST Space Mobile. Okay, I'll talk about AST Space Mobile. Why not? So they issued shares, and the typical knuckleheads complained about it. They issued shares at a discount to the market price. Blah, 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 blah. We knew all along they were going to issue shares. We talked about it, and the market still had a hyper reaction. Why? Because people just don't know what they're investing in, and they don't read anything. Over and over and over again, I will remind you of that. So when the market has a hyper reaction like that, you should take advantage of it. Buying AST Space Mobile below $5 right now is a pretty smart move. If you want to take the risk that they will eventually succeed in deploying their network of satellites for direct-to-the-cell phone voice and data. Because there is a chance they could fail, maybe there's a terrestrial hurdle they can't get over, although it certainly seems like they're crossing every hurdle off the list. Every challenge that they've had, they've eventually gotten there. So if you haven't owned AST Space Mobile, probably should buy some. If you already own some and you just want to decrease your cost basis, sell some cash secured puts, maybe at $4, and then eventually it comes back up. The shooter still says it's going to around 17 or 18. And I'll tell you this, that's just on the technicals. The technicals don't always understand the upside of something. If this network gets deployed, this is probably an S&P 500 stock. We're going to finish on the big trade right now. Aemetis came all the way down. But look at some of these rallies straight up. And this rally here, he's saying 14 to 17. I will remind you that the hard assets of the company, the 2 refineries, all the land, the pipelines, the digesters, are probably worth about $2 billion if you had to start from zero and get to where they're at now. They have $500 million in debt. So that means that the hard assets of this company are worth about $1.5 billion. Even if they fail at executing their business plan, that means that they could still turn around and sell this company for probably about $1 billion, right? There'd be some discount to the hard assets. Around $1 billion, even if the business fails, or just sell all the stuff to Chevron or Exxon, or California Resources or whoever. BP has been buying stuff. So until this stock is at about $1 billion market cap, I don't think there's hardly any risk at all. Is there volatility risk? Sure. People are people, traders are traders. Traders trade because they think that they're smart, even though 4 out of 5 of them lose over time. Same thing that drives people to gamble at the casino is really the same thing that drives 4 out of 5 people to trade. And the smart thing to do if you're a trader or an investor is bet against those people. Take the other side of the bet, because most of the time, you're going to win. And your losses will generally be small. And some of your wins will hit the jackpot. Hope you're understanding the correlations here. So here's what I think with Aemetis. I think that the next catalyst is at CARB, California Air something or other board, is going to make a positive announcement about how the tax credits work and how you qualify. They're scheduled to do it in July. I think you might see it at the front end of the month, because we know that they had the meeting in June. they're scheduled to make the announcement in July, is another positive catalyst. That'll be 3 in the space of 8 weeks, 10 weeks. Stock already has bounced off its bottom at about $1.50. It's over 7. I think it can get to 17, 14, 17, and even 22 in this range, quite possibly in August. Because if those earnings that they announce in August are what I think they're going to be, stock's going to rally, you're going to get a short squeeze, and it could even shoot up to new all-time highs. I think that's very likely by November, because I think they announce at the November earnings plans to IPO 10 or 12% of the India plant, which will make them 50, 60, 70 million dollars cash. So you want to keep buying the dips on Aemetis. You want to keep selling cash secured puts. And if we get like a $1 or $2 dip, those $7.50 January calls that I'm long, I'm about 3,000 of those options are me and my clients. I'm guessing thousands for folks listening. If this stock gets towards 20, boy, that's those are some giant gains. Calls that you can buy for $2.30 right now. If you can get them under 2, the stock goes to 20. Now all of a sudden they're worth $7.50 plus $12.50, right? So whatever it is above the strike price is what they'll be worth, plus a little bit of time value. So buying those calls below 2, I think, could be a 4, 5, 6, 7, 8 bagger by the end of the year. That's the type of trade that you should be trying to make if you're going to trade. So if that's the only trades that you look to make, you won't do many of them, but you'll know exactly what you're doing and why you're doing it and what your risk parameters and what your potential gains are. This is the first call option I've bought since 2018, and I think this stock is going to be one of those that Lynch talked about, that is a big gainer that makes up for some of the near misses in your portfolio, or the stocks that should have been good but management sucked, which is unfortunately part of the game. Sometimes management doesn't execute. This guy, McAfee, who played a very long game, seems to be executing. All you have to do is take a look at the press releases and match them up to the things he said over the years. It took a little longer to get there because of oil market disruptions, COVID, regulatory things, and just the general fact that we haven't hurried on fighting climate change, which we are starting to discover was really, really stupid. And anybody who hasn't noticed that Canada is burning should pay attention, because the secular trends, which I have talked about before, being where you start when you invest, are accelerating. They're not only accelerating on the climate change front, but on the technology front, the fourth industrial revolution, the perfect marriage, as the Samsung CEO put it at CES 2020, between IoT, 5G, and AI. And the biggest winners in AI aren't going to be necessarily the companies that create the AI. It's going to be the companies that use the AI. Imagine how efficient some businesses are going to become when they can cut a third of their workforce and give everybody an AI assistant to work with that can crunch numbers, do spreadsheet stuff, and all the mundane rote tasks almost instantly, versus sitting there and having to grind them out as a human. And then you take the human and add an AI assist, and those businesses have a surge in productivity, which we know drives economic expansion. So while we might be a little heavy in coders right now and other types of admin people, we're still way short on service people, healthcare people, teachers, who are going to get an AI assist as well. And remember, just to finish off with this, as we go into the 4th of July, we think about our freedom. Technology has always created more jobs than it killed. And with flattening demographics, right, fewer babies and more old people, and the need for people to take care of old people and stand behind counters and fix stuff and build stuff, the economy will change as it always changes and evolves. Standards of living will go higher. Work will get less physically strenuous. I've showed you the robots that can do a lot of the construction heavy lifting. These dystopian ideas and images and thoughts and negativism that's out there have always been wrong. Not that we don't have setbacks. They've always been wrong. Think about how we lived 2,000 years ago and the dark ages to where we are today. Could there be a step back for half a generation? Sure. It kind of happened during the financial crisis. Could it happen when the boomers are all retired and we have to make a transition with Medicare and expenses? Sure. But I've told you that I think we've already mitigated a lot of that. I think COVID allowed us to pull a lot of the bailouts forward. That's why there's so much money out there right now, even though they're shrinking the Fed balance sheet. What you're going to see most likely, a couple hiccups, especially around the boomer retirement near the end of the decade when they're all on Medicare. But over the next 15, 20 years, over the next generation, with energy getting cheap, which is apparent to anybody paying attention again, right? OPEC can't even push the price of oil up. So as energy gets cheap and productivity, which is assisted by AI, improves, and people start catering to other people who need their services more and more, and the Z generation is already embracing that. My daughter has, and she makes six figures as a 25-year-old. You're going to see a better and better world with more freedom. I'll talk about this on Thursday. I told you that Putin was going to be done. It just depended on how it happened. And right now it looks like it's happening the best way possible, with the right wing getting purged after the quasi coup, which is going to leave nothing but reformers and moderates that he'll try to control, but eventually a new Gorbachev will arise, probably someone even further to the center. The world's getting better, folks. I know it's hard to see because we do dumb things and we have some cowardly politicians, but the world gets better over time, and we are about to see a super boom. Again, caveat, unless we blow ourselves up, in which case, who cares? Think about the freedom the cheap energy and AI is going to create. That is the 4th of July message. AI and cheap energy are going to create a lot of freedom. And people who invest early and people who adjust their livelihoods early, like a lot of the Zers are coming straight into it, are going to do very, very well. And everybody else will catch up over time. Happy Independence Day. The world's getting better. The charts are going to help us play these waves.